Okay. Well, let's get rolling.
Okay, great. So I got a couple of things I wanted to talk about today. It is September 10th. So speaking of September 10th, I was looking at something I saw a picture today of September 10th, 2001. And I don't know where you were, but it was kind of neat to see that and to think, wow, that's coming up on 20 years ago,
That was a Monday. I
which
remember
is
that.
incredible. Yeah, I
That's
don't remember. That's funny. I don't remember. I thought it was a Tuesday, but I don't remember which day of the week it was. Oh, September 10th was, yeah, September 10th was a Monday.
because it was a Tuesday.
Yeah.
I was in my Tuesday class. I was homeschooled,
Wow.
so we went to class once a week with a whole bunch of homeschoolers.
Hmm.
And then you had schoolwork for the whole week. And I remember I was in, this is about to date everybody here. I was in fourth grade,
Wow.
and I was sitting in my history class, in my homeschool history class on a Tuesday, and they turned on the news and they had this
Yeah.
big box TV that they brought in, and I was like, what's this? Are we gonna watch a video?
Yeah. Were you even
Uh,
old enough to really understand like what was going on?
I think so.
Yeah.
I think so. It definitely felt like it.
Yeah. I was volunteering with high school kids at the time, and I remember well, I should say later, I volunteered with high school kids, and I remember some of them were old enough to have an emotional response to it and recognize what was happening, and some of them were too young to really get it, like what was going on at the time. So
Yeah.
it's interesting to know that even that within a family has different impacts, and
Hmm.
um, but uh, but anyhow, what I want to talk about today, a couple things that are going on in the market to look at that I think are important. Starts with international investing. The way that we have built portfolios, we don't have much in the way of international investing, but there's a lot of factors that go into where you choose to invest internationally. What are the demographics of the countries you're investing in? Demographics are a primary driver for growth. So when you look at those international investments in different countries, emerging market countries really make a lot of sense to invest in. Frontier markets, countries that have
Hmm.
great demographics, but it hasn't really been a great place to invest for a while now. I think it was maybe 2 years ago when India was doing really well, and I was excited about India, but it hasn't really done much since then. And and what we've had since March, the correction back earlier this year, is we had a real spike in the value of the dollar as it relates to other currencies, and so at least if you had some international investments, you'd have some time where the dollar would probably weaken and pull back a little bit from its strength, from its strong position, and that's exactly what's happened. And if you check DXY as a symbol in Yahoo or Google or wherever, you can see that it spiked up in March and has just trailed down to the point now where it's in the very bottom part of its range. I really don't expect it to go much lower. And in fact, we've talked about this many times, and I think this is a good place to start our conversation about this, where people can listen into us. Is what's happening to the dollar? What's going to happen to gold? What's going to happen to all these different ways? How do you protect your money in an environment where the government's just printed $4 trillion and China's printed trillions of yuan, and every country in the world is doing the international debasement technique of printing, of making money available through loans to their society, and it causes a lot of problems, and it puts us in a position where you really want to know what can you do about it. And there's not much to be done, unfortunately. To get the bottom line up front, there is that there's just not much to be done. But one thing to keep track of is the DXY. So the DXY is a dollar, against a variety of currencies, right? Euro, Canadian dollar, Aussie dollar, and those general currencies have shown some strength since March because they're developed markets, and in general, developed markets have a pretty strong central bank and the ability to sort of deal with stimulating their economy as much as they can. So they've done that. Um, Emerging markets, on the other hand, don't really have that function so well. They require U.S. dollars to operate. They require um, funding arms, a certain amount of U.S. dollars to just provide liquidity for their transactions within their country and for certain assets that they need. Things like oil and gas, international trade, all of that mostly happens in dollars. So it's put a lot of pressure there. And again, if you wanted to look at a place, we could look at Turkey and see what's going on in Turkey with the lira. They've been suffering pretty heavily, and that's sort of the tip of the spear, so to speak, of what looks like might be happening in regard to the emerging markets. And there's two developments or two things that are going on, and one of them is that um, you have a demand destruction as a result of the impact of coronavirus. And the second is that the dollar has weakened pretty substantially. So if you're going to invest in emerging markets right now, or even internationally in general, you have the dollar working against you because now we're at a low point. As the dollar strengthens, that's going to reduce the value of your investment overseas. So that's a headwind to performance. And the second thing is that we're still in an environment where we can't seem to, with all the money printing in the world, stimulate us out of the demand destruction that's happened as a result of coronavirus. So, I was taking a look over some positions, and some people do have some international investments because, again, we had a relatively good makeup for that coming out of March. We certainly had more international investments going into March, and I think that it makes sense to go back and evaluate whether or not we should be keeping those positions with the dollars as inexpensive as it is. So, um,
Yeah,
yeah, that's my thought at the moment in regard to international investing.
yeah,
Um,
and I think as we see it being as weak as it is, as it strengthens, it would make all the sense in the world to only be invested in the U.S. as that strengthens back, to its stronger point. Um, I think you would just see that really hurt international investments unless you had some sort of U.S. dollar
yeah,
hedge. It it would still, yeah. I think it will show up a
right.
lot in the returns in the U.S.
Yeah, and I mean that brings up a good point. Dollar hedge. As we've talked about, what do we do for like bonds, right? How do we replace bond exposure with interest rates being so low? How do we hedge a portfolio? How do we protect a little bit when things aren't going to go our way in performance, and what kind of things provide us with better returns? Well, if the emerging markets, if you think of it in a series of three concentric circles, right in the center is the dollar, because the dollar is just, that's the core, and every it is the reserve currency of the world. And then you have other currencies that operate around it that are also strong. They have some of the components that would give it a potential to be able to become a reserve status if they were able to do it, but none of them have been able to replace the dollar. The currencies like the euro or the Canadian dollar or the Aussie dollar, the yuan in China, they certainly, people talk about that becoming a currency that they can keep, but it's most likely not going to happen because of a variety of issues. Closed capital accounts, for example, in China, not really having much in the way of federally issued bonds in the state of the euro, because the euro doesn't have all of its member states issue their own bonds as opposed to having a federal bond. There's a lot of issues with them not being able to take that dominant position away from the dollar, but they're still have functioning economic systems. And then you move to the emerging markets where they're usually pegged to the dollar, and they don't really have an ability to really manage their own economy so well. They're so influenced by the changes in the dollar and so forth. And what happens is when the dollar weakens, it provides an overflow to these different places that benefits them. And likewise, when the dollar strengthens, it pulls it from the emerging markets into the developed markets into the United States. And so if we are at the bottom of a range, we should expect that to start flowing back out of the emerging markets into the international markets and into the U.S., which should cause,
Wow.
unfortunately, trouble in emerging markets. So, looking at Mexican peso, the Brazilian real, those kinds of places, and keeping an eye on what's happening in the emerging markets will be an indicator of what's going to ultimately be happening to developed markets if it doesn't stop, right? And March was a great example of this. If you look at March and the DXY in March, currency was a huge problem. Everybody was demanding dollars. It was causing a huge sludge in the global financial system, and people weren't being able to get the dollars they needed to transact, which is a which is a really really big problem. So that the government came out, the Fed came out and said, okay, we will extend swap lines. We basically allow dollars to be available to you in the emerging market countries without having to go through formal traditional channels. We'll just make it available to you. You just swap it with us. You give us your currency, we'll give you our currency, and you can do it. And the government came out. We established swap lines with more than a dozen countries to be able to alleviate the concerns, which worked. Right at that point, when that happened, that really kind of opened up a lot of the transactions, and that was about the time of the bottom, actually, in March. I don't know if they're related or not, but the point is that at that point the currency pressures started to alleviate, and again, the Canadian dollar, the Aussie dollar, and the euro have really rallied against the dollar and pushed down the price of the DXY. So I think keeping an eye out for that, and even considering maybe looking at a position in the DXY, because this isn't like, people have a tendency to look at the yen. So we haven't talked about the yen, right? The Japanese yen. Japanese yen is its own world.
Oh yeah,
I mean,
I have noticed that
they've
part.
done everything that we're doing now, like 20 years ago, and their economy has basically been stagnant as a result. Their
Hmm.
markets have done nothing for 20 years, and now the central bank of Japan owns tons of equity investments and everything in Japan, and it's a good case study of what not to do, and yet we kind of inevitably are heading in that direction.
Hmm.
But notice I haven't really talked about the yen much, because it took the yen basically 10 years of sitting there doing nothing. Well, we're, as a reserve currency, we don't get the luxury of being able to just do whatever we want and having it not impact the rest of the world.
Hmm.
The things that we do will impact the rest of the world, and the things that the rest of the world does impacts us because of
Hmm.
that relationship. So we should expect that we're going to see a strengthening of the dollar, and that it's not going to take 10 years. It'll take 2 years. It'll take 3 years, maybe. It could take as few as a couple of months to see more of this issue happening in emerging markets. In fact, I think it will only take a couple of months because of the economy not really restarting,
Hmm.
and the fact that demand destruction has happened.
Hmm.
So, yeah.
Yeah, it's kind of a, I don't want to call it this, but it's kind of a ticking bomb, it seems. I mean, with no demand, and I mean, like you're saying, as much as you pump into it, if it really doesn't change things, you, it's like, what's it like, the battery of a car, and how once it really dies, you can't just like jump it back. It's, you can jump it, you might get a little bit of life out of it, but it's still going to like, it's a dead battery. It's done. It's
Hmm.
kind of like that, and it's really hard to push demand back in.
Yeah. I was talking to my brother-in-law. He keeps he has an alternator, an extra alternator in his trunk, because he knows his alternator is going to go bad soon, but he doesn't know when, and he doesn't want to replace it too early. So he went ahead and got it. It's sitting in his trunk. He's just waiting to install it whenever he feels like he needs to get it keep it charged up. So yeah, sorry, you're
Is
thinking
that
of the
something
battery.
you would do?
Yeah. No, I wouldn't carry the alternator in my trunk. I would wait till I needed one, just order it. I mean, come on, we have Amazon, right?
That's
I
right.
mean, having said that, it was, I don't know when he got it. He could have gotten it during the coronavirus time and thought, well, maybe it'll take him forever to send me an alternator, and I don't want to wait to get one.
Yeah,
But I thought that was pretty funny when he was telling me he's got an extra alternator in the trunk ready to go whenever it needs to be replaced.
I love it.
Yeah,
I love that now that he has his new alternator, he's still waiting to replace it. Like I love that
right.
he's
Got
gonna
to use the
like
old one.
work,
Got to wait.
yeah, work it all the way down to the last bit of
Yeah,
life.
don't want to. It could take a couple of years before he needs it. That's what he told me. It's like, might be a couple of years. I don't want to jump the gun and replace it. That's pretty funny.
Wow.
But uh, but
Um,
yeah, I think demand destruction is a bigger deal too.
mhm,
And this relates to oil. I know
mhm,
we have a lot of clients that are invested in oil in one way or another. We've used oil as a diversifying position, because we recognize that at some point the economy is going to recover. And if you look at the sectors and you just looked at what's the top performing sector and what's the worst performing sector, right? The top
mhm.
performing, tech, and the
Right.
worst performing,
Energy.
energy, maybe materials, but mostly energy. And when you see such a disparity like that, and you look
Mhm,
past any time period, there's inevitably a reconciliation of those.
Mm-hmm.
There's a mean reversion that happens. And so a good way in building the portfolio, and for many of our clients will see that in their portfolio, we have exposure to energy. So then that's tied to the price of oil, generally speaking. And if we look at oil, you'll see that it just hasn't picked up. It hasn't recovered. It hasn't recovered as quickly, I think, as we were hoping
Yeah.
that it would. And that's because of demand destruction, right? As much as we've printed money, as much as we've done things to be able to make funds available for growing businesses and doing things,
Mm-hmm.
people are still not driving. They're not going places. They're not doing things. I mean, and with education at home, how many people spend their oil and gas on driving to school, driving to baseball practice, going places and doing things. And
Mm-hmm.
I mean, you're not here in DC at the moment, but just driving on the roads, it's not the normal school start here. I mean, usually the first week when you go back to school is the worst
Mm-hmm.
traffic ever. It
Yeah.
happens to time in with the end of the August recess on the Hill, and it's just like we're here
Gosh.
stuck in traffic, and you can see that people are not really taking the opportunity to be on the road. They're
Mm-hmm.
just they're at home, or they're traveling less or whatever, and there's just less demand for oil and gas.
Mm-hmm.
Now, I'd like to think that's being made up for all those people out there buying campers and taking advantage of school, not at the schoolhouse. I don't know how to say that. School from
Mm-hmm.
home, and they're buying their campers and going out and enjoying life and doing that. For people who can do that, whatever job they have, that they can feel like they can go around camper, it's awesome.
Mm-hmm.
Um, but that that those few people are not making up for the fact that the vast majority of us are not consuming as much oil and gas, and
Yeah. I
not
mean,
flying on the airplanes, and just not consuming the way that
yeah.
we have before.
Really, I feel like not flying is probably one of the big ones. Not flying, not taking cruises. Like, who wants to be stuck on a cruise ship for a round two of coronavirus in November or something? I just don't see it happening.
Yeah.
Um, but
Which is funny, because we all know in the back of our minds, like, when's the best time to do something? Right
right
after
now,
disaster, right after disaster struck is the best time to take advantage of. They're gonna be cleaning like crazy. They're gonna have everything
yep,
shape. It's a great time to be out there,
yeah,
flying on the airplane. I don't know about flying, because the reality is, I think people are still masks and no masks, eating, being close together. How do you take an industry where it's been a push to jam as many people into a
hmm
small space as possible for 20 years, to now say, oh, no, we just spread everybody out and keep space. It's just
yeah.
it's
I mean,
not an effective solution.
I saw something in the last couple of days. I was looking at something for flights, and it said entire cabin of air circulates every 2 to 3 minutes. I was like, wow, that might be
Yeah,
better
but
than like any other indoor space.
well, there you go. I was about to say, I actually have talked to somebody who said that the whatever method they use to circulate the air is actually really great, and it
Mm,
kills tons of stuff. And I remember always thinking, get on an airplane flying to Florida in the winter, right? And you're thinking, oh man, I'm gonna get so sick by all these kids in here that are passing germs around and everything. And the reality is, you're right. I mean, they're purifying the air faster
mhm.
than at any other place you're going to be, but
Yeah,
you still are jammed together, and you still
yeah.
have that kid like two rows back that's coughing, and you're just thinking, it's just a matter of time. um, but
I was telling my wife, I think it was at the end of March. Yeah, that's right. It was at the end of March, and I was like, honey, you want to go on a trip? Because I bet we could do a really,
really
really nice trip
inexpensive.
right now.
Yeah, yeah. I think it
Yeah.
was like a month ago, I saw some timeshare kind of place. You could get a timeshare for a month for $2,500, and some Caribbean location. This was, again, early August or
Wow.
something like that. But to think that, hey, you're stuck, maybe you're working remotely. How would you like to work remotely on St. Bart's or whatever it was,
Yeah.
Um, yeah, it was. I thought that was pretty interesting. I was like, wow, if you can get there, if you're willing to
hmm
fly to get there, and nobody was like really, at that point,
Yeah.
very few people felt comfortable moving
Yeah.
around.
It,
So
it, it's a hard time to be in the transportation industry,
yeah,
anything in that industry.
Yeah.
But yeah, I think, I think we've seen that stagnate in oil prices. And I think we're going to continue to see that still because, as prices normally would increase again, they, would go back up. They would have, demand return, and then they would have everything from the oil bankruptcies, the oil and gas bankruptcies throughout the space that would cause, a tighter strain on the supply. And
Hmm.
normally we would see that price increase, but I think we'll still see uh, basically, I think kind of what you're saying is we're going to see a lower need for oil across the board. So if there used to be, 100 million barrels was the inventory draw, and, a draw would be down to 100 million or something, well, we might just be okay with being down to 60 million or 50 million or something like that because we're just seemingly going to be using a lot less over
Hmm.
at least the near term, at least the next year. We're still going to have, everyone working remotely, doing school remotely. Um, you know,
Right.
a lot of people, even if everyone isn't scared to fly, a lot of people are still going to be scared to fly. A lot of people are going to be scared to go on cruises.
Hmm.
I think we're going to see that down for a while still. But eventually, it's going to cause enough companies to have hard times and go bankrupt and close wells and sell off assets and everything else that it's going to cause such a tight strain eventually. And I don't think, you talked with me about the electric vehicle and solar panels and everything else, the whole boom right now of technology in the energy space. And I think you're right. I think we're still years away from it being across the board. You know,
Hmm.
right now, electric vehicles make up like 6% of the global vehicle market, and although that is increasing so much every day, we're still at 6%, and we still have a whole lot of people who go, I don't know about electric vehicles, but I know how that gas truck runs, and or that diesel,
Yeah. Yeah.
and they're still going to go use that. And so I think, we're not to the space where it's 40%, 50%, 60%. We're still in the beginning of that, and I think we're going to see that
Yeah.
over the next 20 years. But I just don't think we're in the space yet where we can just switch, from
Yeah.
oil and gas
We're totally not.
to solar,
Yeah.
electric vehicles, everything
Yeah.
else. So
Yeah, I think I mentioned to you before, and it's certainly not to the scale, but it feels like the 2000 of energy, of alternative
totally,
energy.
that was a great
We're
example
we're
for it.
not even close to where we can implement it. I mean, 20 years ago, everyone thought we'd be doing everything that we're doing today on the web, like in 2 years. And the reality was, we just didn't have the infrastructure built out. We didn't have the systems. We didn't have the computers. Not enough people had them.
Hmm.
We weren't there yet. We needed to develop it to get there. We needed to have the infrastructure and everything else. And yes, we're starting to have technology where solar panels can pay themselves off in a reasonable but long period of time. We're not to where it makes all the sense in the world to put a solar panel on your roof because of how good the efficiency is and how effective it is for your home. It's still very niche. And I think that it's going to take a long time before we get to where you're in a position where that's going to be taken on. And all of the excitement about solar panels, all of the utilities that are heading hard into them right now. I mean, it looks good. It's great for optics. It's great for a society that's concerned about carbon dioxide and that kind of thing. But the reality is, the carbon dioxide generated to produce those is substantial, and hydrocarbons are exceptionally cheap,
Yeah.
and that's been true forever. It doesn't mean that politics can't get in the way of that, and other things can't impact it, but
Hmm.
um, we have a long time to go before we're going to supplant oil and gas in our society. And as long as we have winters, we will have natural gas. And
Yeah.
natural gas is just, I mean, it's just so cheap right now. It's insane how
Yeah.
inexpensive natural gas is, and oil is inexpensive too, but it's not as inexpensive as natural gas at the moment.
Hmm.
So yeah, I think it'll stay low for a while. I think the global economy needs to recover to where we're starting to use up some of that. I mean, we've seen 20 to 25% decline in U.S. production of oil and gas. and we still have a supply glut. We
Hmm.
still have way more oil. I think I was looking at 500 million barrels of excess, and that is higher than the 2015 2016 glut that we had.
Wow.
So we're coming down on that. Obviously, there's a lot of things that happen in September where we shift from doing summer gasoline to winter gasoline.
Hmm.
Refineries can change, and gas gets cheaper, and that kind of thing. And but I mean, it's not just here. We had that perfect storm where Russia decided to back out of the OPEC deal back in March and
Hmm.
caused oil prices to literally go negative. But I think that you know they're still producing a lot less as well,
Hmm.
and every Middle Eastern country wants to produce a lot more because they need to produce a lot more to make
Hmm.
their budgets work. So there's lots of pressure to produce more as soon as we possibly can,
Yeah.
and everybody's holding their fingers, crossing their fingers, hoping that the economy will cover enough to be able to do it. And the reality is, you you know you when you have a really good functioning economy and you decide to halt it because of an issue, whether regardless of whatever issue that is, it doesn't just turn back on. You can't
Yeah.
just flip the switch. It doesn't work that way. There are too many things that work, and even today, we've convinced people so well that coronavirus is a risk they need to take seriously, that even now, if we go to everybody and say, hey, actually, coronavirus, it really isn't as big of a risk, right? We got 6% of actual people actually die from coronavirus as opposed to with coronavirus. And what was the other news that came out? Oh, PCR tests and the uh, the number of false positives you get with PCR tests. And so we have this higher case count going on, and
Right.
might be due to the way that we're testing as opposed to the A/B testing, the PCR testing, and people can look that up if they're interested in that. But the
Is
point
that
is,
along with
yeah,
batch testing or something?
yeah, you can't wind that back, right? If
Hmm.
once you sell it, that this is a big deal,
Hmm.
people are not going to go to restaurants again until they feel comfortable,
Yeah.
and you now have to convince everybody that they can go back to restaurants before they're going to be able to go back to restaurants.
Hmm.
And it doesn't matter if you open up and say, hey, we're in phase, we're done. It doesn't matter if you're in phase, we're done. It matters when the people feel
Days
like,
were done.
yeah, well, I don't know what phase we're in, phase
Right.
three. How many phases are there? And I remember, what was it, a couple
Remember when
months
he
ago?
came out with phase one? It was like, there's a phase one. Okay.
Yeah. Right. How many phases are there? I mean, what does the process look like? What are the goals? And the goals
Yeah.
have changed. I mean, the reality is, any place that moved to phase whatever and then had to pull back to phase, two or whatever,
Hmm.
when they just go back to phase three again, it's not the same goal. They've actually changed the requirements
Yeah.
for getting back there because they don't want to constantly be moving back
Right.
and forth between them.
Opening
But
and closing. Yeah.
yeah, I mean, the impact that the government response to coronavirus, and
Hmm.
remember we were talking about this back in
Oh yeah.
before any of this happened back in February. I remember we were doing the research on it, and it was still, people were still a little bit concerned about it, but Diamond Princess was out, and I shouldn't say a little, they were very concerned about it. But when we did the research back then, we said, you know what, the virus doesn't really pose that big of a risk to the economy.
Yep.
The risk to the economy is government response. And so that's absolutely what's happened.
Hmm.
We have in the name of it shut down a lot of things, and now we're in a position where um, we are we can't get it started again. We're pulling the cord on the lawnmower, hoping that the engine
Yeah.
will get going, but it hasn't started yet. We're still pulling on the cord. Uh,
Yeah.
and
Let's go into that a little bit. What do you think? So we don't really see coronavirus itself being the biggest risk to the economy.
Right,
Not to say that isn't bad, and not to say that you know many people haven't died from it, because they have. But
right.
you know, do we see it being something that's so big that it like would shut down the economy? Tank the stock market. I know that the stock market was very much due for at least a correction. Um, but the recession that we went through was um, substantial and maybe even much bigger than the coronavirus itself. Um, and so I'd ask just like what are the risks, in government response to the coronavirus, um, what do you see as some of the biggest things that the government has done or could do that are, the most dangerous?
The most dangerous. I mean, the amount of money that we have injected into the society. There's so many different directions to go with that, but I think that probably one of the most dangerous is, all right, I'll say one of the most dangerous is the amount of money that have we have created through the loans. That is the federal government, the Federal Reserve making money available, $4.5 trillion. It's more than we did for all of 2008, 2009, and we did it all within months. I mean, it's the amount of money is absolutely and utterly staggering, and that is a huge deal. That's a huge cost, and I don't think there's any way to get around the fact that that is an enormous cost, and it will have repercussions that will last for. I mean, it's changed our society. It's changed our future. It's changed the United States as we know it.
And how would you say, like, why haven't we felt that yet necessarily? I mean, I know that everyone's felt it a little bit, but
Well,
we haven't
yeah, and
seen a spike in
interestingly,
prices.
right,
And
the stimulus checks were one of my favorite examples of this is like, uh, you know, we're going to pass a law, you're going to owe us, right? If we had to pay back that $4.5 trillion, I haven't really done the math on it, but it's something like each American now owes $120,000, right? You owe us $120,000, and we're going to give you a check for 400 per person. Aren't you happy? Aren't you glad we did that? Wasn't that in your best interest? That was just wonderful. Um, Now, that isn't to say some people really needed it, and getting money in the hands of people really is a way to stimulate the economy. They're going to do something with that, and ironically, the things they've done is they've gone out and bought campers, and people who didn't need it have spent it on things that they want, and people who do need it have spent it on things that they need, right?
mm-hmm,
And that's not great, right? We don't live in a society where we think necessarily that we should just be giving people money, and uh, and so that's a problem because we've now set a precedent for. I mean, we've done this a little bit in the past, but nothing to this degree, and the precedent is now totally set for. Hey, well, there are people who are always in need, and their lives are always an emergency. So yes, coronavirus is an emergency. We did this thing because people are in need. People are always in need in a certain class or certain type of person or certain situation that they're in or certain emotional life that they're going through, and we can do this. That precedent is a huge risk. But yeah, the amount that they printed, the amount that's available that are on the books somewhere that we're gonna have to deal with somehow
mm-hmm.
is astronomical. And what happened to it? Well, it didn't really go in the economy so much. People who get funds like that, or the banks, or the issuing parties, the people who are able to benefit from it, are these really huge companies, tech companies, and
Mm-hmm.
the like, that can borrow money for so little. I mean, Berkshire Hathaway, for example, issued a bond that pays 0%. Now, it was in yen, but he got a 0% loan. What would you do if somebody came along and gave you a 0% loan? Hey, I'll give you money. You just give it back to me in 20 years. You just give me my money back in 20 years. I mean,
Oh,
we know there's going to be inflation, right? We know the value is going to decline over time. We can take advantage of that, right? And certainly Berkshire
mm-hmm.
Hathaway will take advantage of that. They're in a phenomenal position to just do that all day long, get tons
Mm-hmm.
and tons of debt that they can pay back for free, and
That's
particularly.
so amazing that they did it in yen. That he sees it that way, does it in yen. That's the one that's going to inflate, way more than dollars, and it might be a whole lot easier to get,
To pay it back, yeah.
you know,
I mean,
that money back.
if I could get a 0% loan in yen. um, this reminds me. So this is a fun story for you, Daniel. 2006, 2007. Interest rates back then were actually, real.
Right.
People weren't getting a sub three on their loans. They were on their mortgages. They were paying 6 or 7%.
Mm-hmm.
And I knew a couple people who got loans denominated in yen. So there was a way to get your mortgage loan
No
denominated
way.
in yen. Now, there's an advantage to that. The rates were lower because you didn't have to pay as much. But then on the flip side, you had the currency adjustment. So each month you paid your rent, your mortgage, it was a different amount. because you had to compensate for the fact that the currency was adjusting each month. So you had to go in and actually see what the amount was to write the check the right way, and then they had to convert it into yen for the loans. It was kind of a fad. I don't think it stuck on for very long. But think
Oh,
about that today. What if you could borrow money for your mortgage in a currency that you think is going to devalue against the dollar, right? And yen did devalue against the dollar since 2006, but I'm sure there were moments of temporary positive adjustment. But remember, back in 2006, also, we were going through mortgage. It was the real estate bubble, right?
hmm
And everybody was borrowing from everything, and everyone was getting these really odd bubble, balloon payments with
hmm
adjustable rate mortgages. We were going crazy with what kind of mortgages we could have, and
yeah.
I think the Japanese just figured out, hey, we can, some bank, maybe SoftBank, who knows which bank it was, decided we can get on this and make some loans and make some money. And of course, one thing my dad told me many years ago that should always stick with us is when the banks get into a certain kind of investment, it's time to be done, right? They're kind of the biggest, they're
That
the
is
last,
great advice.
they have all the money, right? Banks always have all the money. So when banks start making
Wow.
investments in whatever you're doing, it's time to stop. It's time to sell.
What
And
about when commercial banks become investment banks?
right. So are we saying
Uh,
it's a bubble in the
Is
market?
that
The
when
bubble
it's time
market,
to leave the entire stock market?
leave the market. We did that. That was happening back in 2008, right? That
And
was
now
exactly what happened. AIG.
everyone has an investment branch, right? JP Morgan, Wells
Yeah, that's a
Fargo,
little bit
everybody
different,
does.
right? That's not, so those are private investments. So if I had to say that, where's the bubble in that, right? And investment banks are often, I mean, yes, they're doing deals for publicly traded companies, but they're also doing deals, and this is where the boom really is in private companies, right? We don't see companies IPOing these days at low prices. It used to be that companies would IPO in order to get access to funds so they could grow their company. And so you would be able to buy an IPO and it would be inexpensive. The companies would be cheap and you'd be funding them. Now, if it's a good company, a la Facebook, like what Facebook did, they
Or
raised
Airbnb.
tons of money, or all of them that are coming on the
Hmm
market now. They raise all their money privately, and then they come to the public market to cash out. And coming to the public market is the ultimate payoff for all the private investors,
Yeah.
and it's just a way to shift the owner structure away from the private investors into the public market, and you try to get as much, you try to goose that stock price all the way up. I mean, I remember when Facebook went public. It started out in the 20s, I think, and it went up to the 30s, and it got all the way up into like 42 or something like that. I think it was 42 that it IPO'd, and it promptly dropped all the way to under $20 a share because they overpriced the IPO. But
Mm,
that's what you want to do as an owner. You want to price the IPO as high as you possibly can, and every
yeah.
investment bank has the opposite incentive. They want to price it as low as they possibly can because
hmm
they get more shares and they can sell at a higher price. And Chipotle, great example of the worst section for IPO. Their stock went up 100% the first day or the first week, and it's because they priced it too cheaply. They should have looked at the market, and this is what Facebook did. They increased their IPO price because people were willing to
hmm
pay for it. As long as they got enough money to successfully complete the IPO, they should IPO it for as much as they possibly can.
hmm
And Chipotle left tons of money on the table by IPOing and having the market be, quote, a hot IPO where it goes up, 80, 100% on the first day.
hmm
So we don't see those anymore. I mean, we're looking at Snowflake. Snowflake made some news, right? Snowflake's a cloud computing platform,
Right.
and Berkshire Hathaway said they're going to be buying into Snowflake when it comes to IPOs. And and
Yeah, 500 million or something.
yeah, honestly, a pittance
Right.
for Berkshire Hathaway. It's a tiny amount. It's
Totally.
like they're just sticking their little pinky in to see how this is going to work out. But I'm sure it's very valuable to Snowflake because when you can say, well, I've got Berkshire Hathaway investing with us,
Oh
then
yeah.
who's not going to be buying your IPO?
hmm
Obviously, the Oracle of Omaha is somebody you want to invest with. But I really think that you're seeing it differently where these companies are already getting big, right? And you're getting lots of IPOs from companies that have already thoroughly exhausted the funding markets on the private side. So
hmm
um, private investments in businesses like angel investing and private equity, I think there's just a big boom there, and I think there's a lot of risk in that space. but we don't operate much in the private equity world. That's
Yeah.
not the kind of alternative investments that we've been doing. So not a huge concern there, but
Yeah. How much do you think the government stimulus, especially since they've agreed to like buy up so many companies who are struggling and everything, and then we watch some of those companies just totally drop. They don't even really report who they're buying. So let's just say they are, you know, making concessions, and they determine that Tesla is someone who's going to struggle because of the struggle of demand for driving. Let's say
right,
no one's
right.
driving. Tesla's going to struggle. They go buy some Tesla, and then it has a 17% drop or a 20% drop, like it did this week.
Hmm.
How much does that almost negate the money printing itself, because that value, and therefore it's like its impact on the economy is just gone. Like overall, long term, our government balance sheet, of course, struggles more, which causes those interest rates to probably stay lower. But how much will those kind of decisions by the government to buy into the stock market, which they can definitely make some very poor decisions, and the amount
Well,
of
the
buying
government,
that they're having is causing such moves in itself.
yeah, the government so far doesn't buy stocks, right? It can invest in the bonds of a company, but so far the Federal Reserve is restricted to not buying individual stocks, which is good. We don't want the government involved, and honestly, in buying bonds or buying stocks. It'd be great
Yeah,
if the government stuck to government stuff and tried not to be involved in the market. But
right.
it's not going to do that. It's going to be involved in the market. And that's why a company like Tesla, which we have talked a lot about before,
Mm-hmm.
has benefited so much from government assistance and the fact that we're in a very cheap funding environment. They haven't had to put the rubber to the road with their vehicles, because they don't need to make a profit. They can continue to borrow money. They can continue to go to the private markets. They can continue to sell their story of how they're a great company and how he's a visionary leader and how he's amazing and everyone should invest with him. And they're buying it despite the fact that they really don't have much in the way of earnings. They haven't had much in the way of earnings. Let's put it that way.
Mm-hmm.
And they've been floated for so long. It's the era where that works. It's the same thing is true for Netflix. It took Netflix. Netflix was better, but it took them some time to figure out how to make money
Mm-hmm.
in the market,
Right.
in their business, and they needed lots of money to get to where they could turn a profit. And they
Mm-hmm.
figured it out. Okay, we can do DVDs mailed at home. Then they quickly realized this is bound for failure.
Mm-hmm.
We need to completely change our business model. We need to drop the whole CD thing. We need to go direct to consumer with video streaming. And they completely dropped the CD and they went directly into streaming. That was a bold move that I think
Change the world.
really worked out for them. It really worked out for Netflix, but they needed all that funding to make it there. So what is the government really doing? The government is basically propping up companies that really should go out of business
Mm-hmm.
and allow for all of that technology and all of that capability and all of the things that company did wrong to be expunged,
Yep.
and allow for a new company to come in and take its place. And
Yeah.
we don't see that, right? We haven't seen that because we're not really allowing these big companies to falter. We're not allowing them to not get the funding presence. And
Mm-hmm.
also, as a problem for our society, for the function of capital markets, we're not allowing capital to go to the best companies, in my opinion.
Mm-hmm.
The big companies can borrow money for so cheap, and they can turn around and find, oh, Waze has a really good street traffic app. We're just going to buy it.
Mm-hmm.
This company is doing something really cool. We'll just buy that company.
Mm-hmm.
Oh, you're a competitor, buy you. And the prices that they're tossing around are just like, I mean, they're lots of money.
Yeah.
And I think they're just too tempted. They're too willing to say, oh yeah, I'll sell to you for that. And if you don't sell, you're going to feel like there's going to be
You're
nights.
gonna feel like
Imagine,
Yahoo.
yeah, you might feel like Yahoo. That would be the worst case scenario, right? But
Well,
there
that's
might
what
be
everyone
nights where
thinks
you're
of.
sitting around thinking, oh man, I should have, I'm going through a hard time with my business. We were doing really well, and now we're going through a little bit of a slump. Every business does that. And you're sitting there thinking, I could have sold this to Google or Apple or Microsoft or you name the big company and made a kajunk ton of money. That's an official amount.
Yeah.
It's more than a million, but less than a trillion. And you go on and you can't.
Range.
Yeah, just a little range.
I could junk in air.
Yeah, and you don't really know what you're gonna. I mean, you're always going to look back on that and think I should have sold it. And then if it does really well, you're going to look back on it and say, oh man, I shouldn't have sold it. But
Mm-hmm.
that kind of pressure, I can't imagine being in a situation where you're offered a very large amount of money to sell a business that you've worked in and not do it. And that's sort of a hindrance. I mean, it would be okay. I think I would feel much better about it if we were in a normal interest rate environment and these companies were borrowing and it was costing them a lot, and they really did the due diligence and said, you know what, your company is really worth us buying it, rather than just saying we have so much of an arsenal, we could literally buy everything, we will just continue to buy everything and keep our moat, than to allow for smaller companies to continue to grow up and compete.
Yeah,
These big companies are actually going to slow our innovation and technical progress, in my opinion.
definitely.
But again, we've gotten way off into my opinions and off of sort of the market. There is one more thing I want, since we're doing this introductory episode here where we're talking about kind of where we're at, and we'll hit a lot of these topics in more depth in the future. But
Mm-hmm.
with this remaining little bit of time here, I do want to talk a bit for a moment about the disconnect between the stock market and the economy. So I think instinctively we all know there's a relationship there,
Right.
but it's difficult to put your finger on what the relationship is. Yes, the economy needs to earn money, that therefore the stocks are going to perform well and that kind of thing, but it doesn't necessarily bear out that a positive economy means that you have stock market appreciation, or conversely, that a negative economy is going to be stock market depreciation, right? Stocks are going to go
Right.
down. And we're seeing that right now. We see a huge disconnect right now in the market where earnings are have flattened out and are tailing down over the past 4 years or so, 3 or 4 years,
Right.
and stock
Besides big
prices.
tech.
No, even with big tech, the relationship between their earnings and their stock prices has spread.
Hmm.
Right, that amount is a huge difference than what it used to be. They used to trail together, right? So as their earnings would go up, their stock would go up, and generally the PE ratios and that kind of thing would be consistent. And now we're seeing a much larger spread between
Mm-hmm.
the overall earnings of, say, the S&P 500 and the price of the S&P 500.
Mm-hmm.
And it's been spreading ever since 2014 or thereabouts. We've seen pretty widespread, and a lot of people will look at that chart, bearish people, and say, oh, this is evidence that the market's going to drop and the prices are going to go down, and you heard it here first. Um, but I really don't think that's the case. What we have happening right now is a phenomenon that I am not the initiator of, but have read about and am in agreement with, and that is that there's a significant amount of money that is buying the market through index funds and target date retirement funds and what is traditionally called passive investing. There's
Mm-hmm.
not really anything that's passive about it, except that the decision making involved with that purchase is, do we have cash coming into this fund? Yes, then buy. Do we have a request for money? Yes, then sell.
Mm-hmm.
It's completely price insensitive. And I just want to say that again because of how important that is. It is a price insensitive buyer. So it doesn't matter what your earnings is. It doesn't matter how expensive the company is. All it says is, do we have money coming in? Yes, then buy.
Mm-hmm.
And what happens when 20%, 30%, 40%, 50% of all the assets in the market are in that kind of investment, in those kinds of funds? All of the managers that make up all the market, let's say 50% of them are just going to buy if somebody says buy and sell if somebody says sell. They're not going to look at the valuations. They're not going to
Mm-hmm.
look at the any of the traditional metrics that are involved with determining whether or not you're making a good purchase or a good sale.
Mm-hmm.
And that distorts the market. There's no
Yeah.
two ways about it. That absolutely distorts the market, and that is exactly what's going on today.
Hmm.
All of this pressure, and pressure is the perfect word for it. That's exactly what it is. It's like somebody pushing. It's like water in a stream, constantly pushing along. Now, will you have rains and will you have droughts where the flow is going to be less or more? Absolutely. That's the traditional. That's the other 50%, right? That's the other part of it. Is the
Hmm.
economy allowing? Is it raining because the economy is growing? Is it drying up because the economy is slow? Okay, then it's not going to grow as much. But there's still a flow, and that
Hmm.
flow is because you have constant investors putting money every month because of their 401k contributions and that kind of thing,
Hmm.
every month going into passive investing process, and it's going to just continue to push up the market. It's not only going to push up the market, it causes for more volatility,
Hmm.
right? And this is what we've seen, right? And this is like the proof's in the pudding here. March, and even a couple days ago, this
Yeah.
week, we've had big stocks going up 10, 12, 13%. And it had me worried. I called my dad and I said, "Hey, Dad, what is going on?" And yeah, I know you're thinking, well, who's your dad? That he's an expert you should talk to. Well, come on. It's emotional. It's helpful just to talk to Dad, make sure things are good. So I call him and I say, "What's going on?" And he says, the markets do this kind of thing. You got to have a strategy. You got to know what your risks are and measure those risks and take care of it. And it's very comforting. But the reality was the market was moving up too fast, and I knew it. I knew it was moving up too fast than what's sustainable, and we were priming ourselves for a short-term mean reversion. We literally, some animal came, sat in the creek, and it just piled up behind it. Then he got up and moved, and it was this huge wave that came, and then it slowed down afterward. Right? It's like we had this big wave, and the wave turns out to be an investment bank in Japan decided to buy tons of options on NASDAQ related stocks, individual names within the NASDAQ. That's what the big wave was. And when it was revealed that that was the case and those funds stopped coming in because it's all about flow, then we had to reset and all the prices dropped. And that's basically what happened over the last week. So again, we have this underlying flow, but we have other things that are happening that are driving stock prices. So we saw that. And what happened as a result of that, stock prices went up by 10%, 8%, 6%, 15% in some cases or more in really big company names. And we're talking about billions of dollars, almost $1 trillion of asset of increase in prices of market cap in these big companies in a couple days, in a day. And that's just not sustainable.
Hmm.
And then immediately it stopped and it turned back. And for a couple of days now, starting Thursday last week, it's Thursday again this week, it started pulling back down. Right, we had the same rush back down. The way to think about that is, let's say you have 100 people that are participating in an environment, right? And they're like, you're at a party, there's 100 people. Take 50 people and you say, okay, for these 50 people, they can only do one thing. They can only buy, right? We're making this environment, it's a market, right? And we have
Hmm.
buyers and sellers, and 50 people, all they can do is buy. And when markets get a little crazy, like they did in March, they just don't do anything. They just stop because the buying pressure stops temporarily because there's enough people selling also that they kind of just pause. Now you got 50 people that have to figure out the prices now. It used to
Hmm.
be you had all these people sitting together to make this market, and they were able to find people that they would trade with. And now,
Hey Dan, it's cutting out.
oh, okay.
Oh, now you're back on.
Now
Go
I'm
ahead.
back. Now I'm back.
Yeah,
It's the pleasure of Zoom. It's the world we live in.
that's right.
Um,
So there used to be a full,
a
free
full room.
market, and now there's
Now we're
50
taking a
that
bunch
are
of people
just
out,
buying.
and we're still expecting to have the same amount of transactions. We're still expecting to have a fluid flowing market,
Hmm.
and yet we've taken half the people and turned them into rock because they're not trading. Right, their only trade is money coming in, buy, money going out, sell. They're completely uninterested in valuation.
Hmm.
So if all of a sudden there's a need to say sell a little bit of something, and you go out and you say, hey, I want to sell 200 shares of whatever, but let's be realistic, it's this market, right? 2 million shares or
Right.
200 million shares of whatever. Um, who's out there to buy 200 million shares of what you're trying to sell at the price you're trying to sell it? Nobody, because all the people that are left that are not part of that crew that just buy with that are price insensitive. Now we have price sensitive buyers, and they're looking at the
Hmm.
market and they're saying that price is not a price I'm willing to buy 200 million shares at. If you want to sell me 200 million shares, you need to
Yep.
sell it at a lower price, and we get these big gaps. And the same thing happens on the other side. I need to buy. let's say we reawake these people again and they're back to buying, and they go into the marketplace because they're basically like one big group. They all think they all act the same
Yeah.
way. They say we want to buy 200 million shares of X, and everybody on the active side, everyone who actually owns those stocks who are willing to sell it, say, well, we're not going to sell it to you for what you want to buy it for. You're going to have to pay 5% over whatever you think
Mm-hmm.
that you want to buy it for to buy it. And they say, done. Every time, done, done, done. Why? Because they don't care about the price. So why not make them pay more
Yeah.
for what they're going to sell? And so you're going to see that on both sides. You're going to see this incredible blow ups like we saw earlier this week, where markets are up 5-10% a day.
Mm-hmm.
And you're going to see incredible drops where it's down 5 or 10% a day.
Mm-hmm.
That's going to be the world we live in.
Yeah. And it's kind of crazy because it goes to such extremes. Like, for example, all those buyers in your example, those 50 buyers, they don't ever need to sell except for required minimum distributions. But what did the government
Well,
do?
go
They
ahead.
do sell otherwise. But I mean,
Yeah.
like that's when there's huge outflows, is those kind of things.
Yeah,
Go
yeah,
ahead.
yeah. Let me jump on that, because actually, the interesting thing is that most of the investors that are buying this passive way are younger. Mostly, almost entirely,
Hmm.
45 years and younger. They're almost entirely in the passive. It's just what's available. You go to your 401k.
Yep.
If you're listening, go look at your 401k, see what your investment options are. If you've worked with us, hopefully we've given you some good ones. But most likely, you're going to see that a lot of them are target date funds, and
Hmm.
that's going to be the thing you're defaulted into. And that's exactly what we're talking about. You're going to
Yep.
be buying that position. You're going to be putting your money in with those 50 people, and they're going to be buying it just like they buy it for everybody else. And everybody's impacted by it. But the reason I mentioned that, Daniel, is because you were talking about RMDs. Well, most people who are taking RMDs are in the old school. They
Hmm.
started investing before this passive thing really got popular in the early 90s, when certain documents were written where they talked about the value of passive management or passive investing. And so they're used to investing in the active managers. What you're seeing is an actual, on a percentage basis, more than 100%. So 100% of the money coming in is going into basically passive, and of the money that's coming out, almost all of that's coming out of active.
Hmm.
Right? The net effect
So it's
is we are
increasing.
reducing
Hmm.
actives and increasing passives, to use that terminology. It's not right terminology really, but it
Right.
helps us because of what we're talking about. That's what's happening. So you're not really seeing those sales.
Hmm.
When you ultimately do see the sales, when those 50 people all together, when there's enough selling pressure because the world's falling apart, that they're able to overwhelm the amount of buying pressure in their back offices, right? Because again, we've talked about this before, but real fast, when these companies that are doing this, BlackRock and Vanguard, are bringing these orders to the market, if they have in their own office a buy order and a sell order, they're not bringing that to the market. They just settle it internally. So all they do is they take the net amount of their orders and they bring that to market. So
Right.
that's why I said they stepped out. Why did they step out? Because enough people were selling within their world that they were only bringing a trickle of buy orders in during that March period. I don't know what the numbers are, to
Hmm.
be frank with you, but obviously they weren't as much there and active during that time because we had so much volatility of other things going on. Obviously, it
Right.
was clear the active people were, and Vanguard actually came out and said less than 50% of their accounts even transacted during that period. So literally
Wow.
most of the people there, they didn't even transact.
Yeah.
Again, these are long-term investors. These are perfect kind of people that are using the market the way that it was intended to be used. You buy, you hold it, you don't worry about the market, you just go with it. That's common historical knowledge of it. The danger is what happens when that doesn't, when this continues. There's going to come a time that's a really bad strategy. Um, but
Yeah.
I say that because when there's ever a sell order that actually reaches the market, the exchange, when enough of the back office happens that they've balanced all their buys and sells, and it turns out they actually have to sell in the marketplace,
Hmm.
who's going to sell to them, right? And that's the real risk, is there's not going to be many people to sell because they are the sellers. They're the holders. They're the ones that have it. And they're doing all that in the back room. They're not
Hmm.
allowing those transactions to be seen on the marketplace. They're handling all of that without any view, any transparency
Hmm.
to that. So when they finally do hit the market, imagine if they hit the market in size. I mean, there's just no. There's $7 trillion are managed by, I can't remember if it's Vanguard or BlackRock, but seven
Vanguard.
trillion. Vanguard probably, yeah.
Hmm.
7 trillion of a market that's of total 60 trillion. I don't know what the number is today. I could look it up, but it's not that
Well, it
much.
was 29 trillion in 2018.
Oh, okay.
So
So I might be thinking of all the
2019,
monetary base.
might have their numbers out, but yeah, it was like 29 trillion in
Yeah.
2018.
So anyhow,
So
the point is, it's a huge amount,
huge portions,
and
yeah.
there hasn't really been an they haven't sold in recent memory. There's never been a day where at the end of the day they say yes, we have to sell.
Hmm.
I think if there have been any of those, they've been less than 10
Hmm.
in the past decade or two,
Yeah,
including 2008, including March and everything else.
yeah. Well, that's pretty wild because something I think about is I was reading an article on the end of 2018 and why the
Hmm.
crash in
Oh yeah,
September and then the spike up through December, and how it was RMDs that caused that spike, and how people um, people pulling out their money and like basically forcing the sale. Am I saying that right? No, something like that. Maybe it was
yeah.
the RMDs in September or something like that, and how something had driven it down. But how
Hmm.
big of a swing it caused, and how this year, with the government with the CARES Act allowing the RMDs to
Yeah, no
be
R&Ds this
taken
year.
out,
Yeah,
it's like I think they're introducing an idea of, well, maybe we don't have to force the RMDs so that it can cause further and further momentum. And, you know, so far, that's just my theory. But I think that they're seeing how big of an impact it has when that happens. And if they do force RMDs and it does drive the market down, they're going to have uh, people not wanting to invest if every single year it has some massive tank. They're like over time, let's say, as those younger people become older people and
yeah,
the real money in the market is all in 401ks, those it's going to have such massive moves. It's not sustainable to have those RMDs,
yeah.
um, at least, not unless they're spaced out throughout the year or something.
Hmm.
But yeah,
Well, this is a bubble. We don't have to worry about 10 years from now. I
yeah,
don't think we're going to get to 10 years from now.
yeah.
This will resolve before 10 years from now. But it is, I'm not sure, anything, trying to determine, was it RMDs in 2018 that did it? You know, Even if you pointed at the last straw on the camel's back, that's still not really the cause. The cause is all the straws on the camel's back, not the last straw.
Hmm.
So looking at it and saying, "Hey, trying to determine what the actual catalyst was." Going back to 2008, there were a lot of things, and I think an appropriate interpretation at most times is to say there's a lot of things, and not to
Hmm.
try to point to one thing and say, "Oh, it was this one thing that did it." Well, that's often misleading. 2018 was fascinating for a variety of reasons.
Hmm.
That crash in the rally at the end of the year. And it could be that RMDs were involved in that, and it
Hmm.
could be that RMDs is involved. I suspect that the amount of money that comes out from RMDs is not so much that it drives the market. Having said that, I do know that rebalancing is a bigger influence, and a lot of people do rebalance near year end.
Hmm.
And if they're rebalancing out of an asset that's done pretty well, it
Hmm.
can drive down prices. And that's another thing we haven't even talked about with all these passive people. I mean, these funds that they manage, it's not all just long stocks, it's
Yeah.
bonds and everything too. If you ever wonder who's owning, this is just a little thing to tickle the back of your ear here. um, who's owning these negative yielding bonds globally? Well, it turns out that if you own the Vanguard total bond market, or you just own BND, the ETF BND, you own negative yielding bonds. Most of the negative yielding bonds are owned by individual investors through Vanguard. Those are
Wow.
the biggest holders of those bonds. And it seems ridiculous on the surface. Why would you ever hold a bond that had a negative yield?
Right.
And we should all ask ourselves that question and then say, okay, if we are, how are we owning them? And if I am owning it through BND, why am I owning BND? Well,
Hmm.
you shouldn't be owning BND. not giving advice here on this show, but this, us talking here, but you should seriously consider if you're owning BND, whether or not you should be owning BND.
Mm-hmm.
Um, and one more thing that was fascinating about 2018, the day before Christmas was the bottom. The day after Christmas was the start of the rally. So it was a Christmas miracle. But the Christmas miracle that happened there in 2018, the day before Christmas, was that every stock in the S&P 500 was down. And the very next market day, every stock in the S&P 500 was up.
Mm.
And when you talk about the passive impact on the market, right, they don't choose one individual stock, they buy everything. And when you see days like that where everything is down and everything is up, it's a good indicator that there's something going on. There's something at work that is unusual, that has not been the case before.
Mm-hmm.
And one of the driving principles for our decision making when it comes to portfolio management and everything is to say, what structure do we live in today? What environment are we in now?
Mm-hmm.
Not what worked from 1980 to 19 to 2000, or from 2000 to
Right.
2010. You know, everything about those periods were different than what exists today, and we can learn from them, absolutely.
Mm-hmm.
But to think that we're in the same environment as that is just not good thinking.
Yeah.
It's just functionally not true. We
Mm-hmm.
absolutely live in a different environment now. And that's why, like we talked about before, we talked about DXY, maybe, we haven't really talked about this before this conversation right now, but maybe there's a place for that as a protection against, a negative market move. Because when the world freaks out about something, when economies don't do well, when the markets aren't going to do as well, there's a fleeing to the dollar, the flight to safety, as they call it,
Mm-hmm.
and that people buy treasuries and they buy dollars.
Mm-hmm.
And I think it makes sense for us to consider um, putting that in a portfolio, because that's traditionally been the trade. But with bonds yielding so little now, I don't expect the boost that you're going to get from bonds to be nearly as much as it has been in the past.
Mm-hmm.
So in historical corrections, it's been higher. I think I showed you yesterday, the day before, a chart that showed that with a lower 10-year starting value. So this last correction, 10-year, was at 1 point something. Now it's at 0.6 or 0.7. The closer it is to zero, the less positive impact you get in a
Mm-hmm.
negative market environment. Well, the whole reason you own bonds is because when things don't do well for stocks, you have something to sell to rebalance,
Right.
and maybe some income in the meantime. Well, the income's gone, so the
Mm-hmm.
question is, can we sell and rebalance? And I just don't know that we're going to get more of an impact from that than we are from a dollar-related move. So
Right.
long as,
Because so
yeah,
many of those bonds have been so loosely lended to those corporations and to whether it's mortgage lenders, being lended by the Fed, and they've had looser restrictions lately as well. And the interest rate is so low that, basically if someone gets approved, that's it. That's all that matters. It's not like, well, is this a good financial decision for us? It's like the world hasn't really like slowing down to think about all of its decisions yet. And
mm,
like, hey, we can get a house, we can borrow, we can get in there. And
mm-hmm,
it's not like, could we pay this for 30 years if we don't ever move? And if, you know, if anything happens to our incomes and stuff, would we actually be able to sustain this? Well, we could probably borrow more in that time, if we can. And it's just borrowing
yeah,
the answer. And so those bonds
yeah,
that historically, did pay more, they are paying less. But on top of that, we saw a credit crash, you know, like what was it? It was after March 1st, I believe, like March 8th, March 9th. That was what drove down to the further bottoms,
mm-hmm,
was that credit crash. And I think that,
yeah,
bonds are no longer that answer of safety and security, where the dollar still could be. And I think now you're looking at things like volatility or gold,
mm-hmm,
or
mm-hmm,
just like, having a structural change that is something different than um, the old
right,
structure of bonds. Because like you're
right,
saying, that
right,
structure is it's seemingly gone. It's at least decreased in its effectiveness, but it's
yeah,
maybe gone entirely.
yeah. And there's still some values there I mean, there's still opportunity in some places, but
Hmm.
the costs are just too high for a lot
Uh-huh.
of bonds. It was a while ago. This was back in 2008, and shows you how ahead of the curve people are with statements like this, and also how wrong they are, because they were wrong for about 10 years at least. But they called bonds return free risk, because
Yes.
the goal is risk free return, and that's what people always think of with treasuries. Well, it's risk free and you get a return on it. Well, with other bonds, you're not really getting much in the way of a return, and you're getting a lot of risk,
Hmm.
because if interest rates were to move, as for some unknown, unforeseeable reason, we actually had an increase in interest rates, uh, everyone owning bonds would be done,
Yep.
just done. I mean, it's I don't see any reason how that would happen. To be completely clear, like you said, it's in the government's interest to keep rates low, and I think that's the next step. I think that the government is going to have to peg rates, and not just peg rates; they're going to have to buy bonds to
Hmm.
maintain interest rates, and that kind of involvement would be classic for the further destruction of a free market.
Hmm.
That is the next step. When not that I want to compare things to Nazi Germany here, but when they did take over a little bit, they actually, one of the things they did is they did hold interest rates down. They kept interest rates low, and they did that by buying bonds as well to keep interest rates down. And that inevitably, I think we will do that, because we won't be able to allow, as the government owes so much debt, even if it's to itself, um, all of our uh, you know costs would be going toward that, and we can save our discussion on debt jubilee and other things for other times. But
Yeah. But
there is an end game to that. It's not pretty,
mhm.
and it will happen. But yeah,
Yeah.
this is where we are today.
Yeah. And I think there are so many factors that we didn't even mention um, in this whole increased volatility, increased passive investing environment. So many
Hmm.
things, like what happens on the days that those big passive funds aren't buying, and not that anyone's selling, but just they aren't buying.
Hmm.
Well, the only people who are willing to buy are only willing to buy way lower. So it
Yeah.
always means basically a drop. Or, what happens if they are selling, it also means
Yeah, I
a
don't.
drop.
I, maybe I actually think we're going to see the other reaction. I think people are smart enough to know that we're going to see charts, right? And the charts are going to show volume. And when we start seeing that the volumes are ticked up on certain days, we'll start to get an idea as to the rhythm of when these 401k contributions are happening and when they're that kind of thing. And people are going to get wise to the fact that something is happening, right? They don't even have to identify what the cause is. They just have to see the effect. And the effect is there's a constant buy pressure to the market. And you can get people on Twitter and other places saying, "Oh, markets only ever go up." Even when they go down a little bit, they can say, "Oh, they really only ever go up in the long run," right? That's
Mm-hmm.
they just add that in the long run statement there. Um, but it but if that's really the case, then I think we'll actually see the active investors, the ones that are going to survive through this, are going to play the game, right? Just like
Yep.
we are. We recognize that this is a phenomenon. We are not bowing out and saying, "Well, we'll just leave it alone, and we'll come back in a couple of years and see where we are."
Mm-hmm.
We are actively involved in trying to get positive returns for our clients while managing the risk.
Right.
That's exactly what everyone else is going to do, and I think they're actually going to be on both sides, trying to continue to position themselves well, and also reduce their risk simultaneously.
Mm-hmm.
And so I think that we will have I've said this so many times. Um, I hope I'm not wrong about it. I haven't said it so many times, but I really think that we will have a really unprecedented rise in the market,
Mm-hmm.
and people will be shocked at how much the market has gone up. That
Right.
isn't to say it won't be volatile. It will be volatile, but we'll be looking at rates, and we'll be looking at situations. They're already doing this. They're already saying,
Yep.
look at the relationship between growth and value in investing, and we could talk about that another
Mm-hmm.
time. But we're active managers will not remain in business if they don't realize this phenomenon and do
Yeah.
something in regard to it. And yes, there will be the old financial advisor down the street who's been in this for 30 or 40 years, and they're going to do the same thing they've always done, and they're going to have worse and worse performance
Mm-hmm.
than they ever have. And that's going to be a reality because they're just unwilling to change. But for everyone who's going to really be in this and is really going to continue to grow and have a business, they're going to recognize what's happening, and they're going to
Hmm.
position themselves in a way to benefit from it. So I do think that we're going to see, I think we've seen that already with the options buying that just happened recently.
Yeah.
People have figured out, they've gotten wise to, okay, these positions are really doing well. How can I benefit from it? Oh, I can buy options
Hmm.
contracts on these positions, and and even then, the market's going to have to react to the fact that I have all these options contracts.
Hmm.
Um, and if even today, after this 15% drop or 10% drop that we had in the last couple of days, um, if they bought those calls long enough dated, they're going to be in the money. And they're going to make money on that trade,
Yep.
even though in the short term it's been a little painful for them.
Hmm.
They're going to make money on that because the market's going to continue to climb higher as money keeps going into 401k.
Yeah.
And that's what makes it hard, right? What do you do as an individual investor with this phenomenon happening?
The biggest wave we've ever seen,
It's a
you know?
huge wave, and you
Yeah.
can't avoid it. I mean, you can not participate in it. It's
Right.
going to impact you, right?
Yep.
And this is something that we have to realize. It's been true with coronavirus, true with everything. Whatever decisions you make impacts other people, and that's just the truth. So even if you decide not to
Yeah.
participate, you're impacting other people.
Yeah.
And
I mean, like,
it's
for
bad,
example, our entire money system is changing right now. So to not participate is to guarantee loss, basically.
basically.
I mean, because of
Yeah.
over time the inflation. So it really is important to recognize the risk, recognize, get ready for the volatility. You have to be ready to ride it down, and then you have to know and be ready to ride it back up, which is also part of the hard part because you want to sell.
Hmm.
Like once you're in the
Yeah.
green a good amount, it's kind of hard to to hold on. But at the same time, it's such a wave building that it's hard to determine. I don't think that we necessarily can determine when it will be a structural change,
Hmm.
but I think in the meantime, it's about really seeing those things that are moving, seeing those opportunities that do exist, and like you're saying, playing the game with a very strategic approach. Look
Hmm.
at your structural approach, make sure that you're in something that you're comfortable with, and that you are comfortable with the volatility, and then with
Nobody's.
that, and I think with that you can prepare yourself for the at least the near term ahead. I just think it'll be very volatile. It also will be very I don't know the way you always say it, the very like it's going to be a rising stretch. Like it is going to increase a lot throughout that volatile time,
Hmm.
but um, but really it's I think there are those driving factors that really make up such an impact today.
Yeah, it's not going to be easy. I'll give you
Mm-hmm.
that. It's no one likes volatility. Nobody likes volatility. We'd rather it be nice and smooth, up, 1/4% every month for the rest of our lives than anything else.
Yeah, can we all just agree?
Right, right. Yeah, and I think I heard something that was pretty depressing today, and I don't want to necessarily end on a depressing note, but I think it bears worth saying. That is that all of this is all of it's new. There's a lot more risk today than there was 10, 15, 20 years ago, in the market and in investing and in the dollar and in everything that we have going on in our economy. It's always an indicator when you ask somebody who's an expert and you say, well, what would you do? And they say, well, if I were young, I would try to determine how I can invest in myself and have another stream of cash flow, or a better education, or whatever it is. That to me, when somebody says that to me, means you have no trust in anything else, right? You really don't think that any of the institutions that are around, the dollar or investing or whatever, is really necessarily going to work out all that well.
Fed, the U.S. government.
Yeah, they're basically saying get yourself best prepared to handle whatever is going to be coming at you, because you're going to have a lot of stuff coming at you. You're going to have to deal with it. And we don't necessarily know how with the stuff that we've got. So you're going to have to figure it out with your own abilities. So invest in yourself so you can figure it out. And you know, that's basically what somebody who's really smart about all this stuff, who sees all this stuff,
Hmm.
has said. And I just, it's like, well, I guess that is the world we live in. We're going to do our best to navigate it on behalf of our clients. We're going to do their best to navigate it for ourselves and everything else. But it's, it is not going to be easy. I don't think it's going to be, you know, I don't know what the result ultimately looks like, but just like everything, we'll take it a day at a time, and
Hmm.
um, continue to try to understand the features and issues that are driving the market.
That's right. Keep eyes open.
Yeah.
Yeah.
All right.
Well,
Good chatting.
yeah, this was good. And I'm sure we'll be on a whole lot in the future to talk about a whole lot more of those topics in greater detail. But
Sure.
yeah, I appreciate the time, Dan, and we'll talk soon.
Likewise. All right, man. Bye
All
bye.
right.